Welcome to Accounting Botcast.
Today, we're getting into something pretty fundamental for finance,
hmm
financial instruments, specifically how IFRS accounting standards and US GAAP define them.
Right. It sounds technical, and, well, it can be.
Yeah, we know accounting standards can feel a bit dense sometimes, like wading through treacle, maybe.
Yeah, something like that.
But you've shared some really detailed stuff with us, and our mission today, really, is to pull out the key pieces.
That aha moments.
Exactly. So you walk away with real clarity, not, just more confusion.
Absolutely. Financial instruments, they're really the bedrock of financial reporting. And
Oh,
while the basic idea, a contract affecting two parties financially, that's often similar between IFRS and GAAP.
right.
But the specifics, how they define things, categorize them, that can lead to some, surprisingly different results in practice.
Okay, so that's what we're navigating today, those key differences and, crucially, why they matter to you. So let's start with the basics then. Lay the groundwork. What actually is a financial instrument, in simple terms?
Okay, so at its core, it's a contract. A contract that creates a financial asset for one entity
Okay, an asset for one.
and a financial liability or an equity instrument for another entity. It's basically a documented financial relationship.
Right. Can you give an example?
Sure. Think about a loan. If you take out a loan, the bank gets a financial asset that's their right to get your payments back.
Mm,
And you have a financial liability and the obligation to pay them.
got it. Asset for the bank, liability for me.
Exactly. Or say you buy shares in a company. You now hold a financial asset, your ownership stake, right?
Right.
And the company. It is issued an equity instrument.
Okay, so the basics are things like, cash itself, loans, receivables, shares, that kind of thing.
Those are what we often call primary financial instruments. Very common.
But finance isn't always that simple, is it? What about the more complex stuff we hear about?
Yeah. That's where derivatives come in. Things like options, futures, swaps.
Okay.
These get their value from something else, maybe an underlying asset like a commodity or an index or even an interest rate.
And the basic definition covers those too.
It aims to, yes.
Mhm.
The core definition tries to capture that whole spectrum, from the simple loan to the really complex derivative.
Okay, good foundation. Now let's build on that. How does IFRS specifically define a financial instrument? What are its criteria?
So IFRS really focuses hard on the contractual rights and obligations around cash or other financial assets.
Right.
A financial instrument exists if there's a contractual right to receive cash or another financial asset, or the flip side, a contractual obligation to deliver cash or another financial asset.
Okay, receive or deliver.
But it gets more interesting. IFRS also includes contracts where there's an obligation to exchange financial assets or liabilities with someone else
Exchange.
under conditions that are potentially unfavorable.
Potentially unfavorable conditions. That sounds significant. What does that mean exactly?
Well, it's not really a loophole, but it recognizes situations where the contract's economics might inherently disadvantage one party down the line.
Hmm.
Imagine, say, a contract forces a company to buy foreign currency at a fixed price that turns out to be way above the market rate later on.
Okay.
That obligation to exchange under what could become bad terms that makes it a financial instrument under IFRS. It shows IFRS is really looking at the potential future financial hit.
Interesting. So it's forward-looking in that sense.
Yeah, very much so.
The sources also mention IFRS includes a company's own equity instruments. How does that fit? Isn't usually between two different entities?
That's a really good question. IFRS does broaden the scope here. It includes non-derivative contracts where a company might have to deliver a variable number of its own shares,
Variable number.
and also derivatives that could be settled by swapping a fixed amount of cash for a variable number of the company's shares, or vice versa.
Why include
It's mainly to deal with complex financing deals or capital structures where the payout is directly linked to the company's own stock performance.
Okay, got it. So IFRS has a really detailed focus on these potential flows and obligations. Now, what about contracts for buying or selling non-financial things, like goods or services? I saw IFRS sometimes counts those too.
Yes, and this is a really key area where IFRS can be a bit counterintuitive sometimes.
How so?
Well, a contract to buy or sell something non-financial, say, raw materials like oil or grain, can be a financial instrument under IFRS.
Even if it's just for normal business operations.
It can be, if the contract can be settled net, meaning settled in cash or another financial instrument, or by swapping financial instruments instead of actually delivering the oil or grain.
Ah, so it's about how it can be settled, not just how it's expected to be settled.
Exactly. If the economic effect is the same as just settling up financially, IFRS tends to view it as a financial instrument, regardless of the underlying item itself.
But hang on. If I run a factory and I contract to buy steel to make widgets, surely that's just buying steel, not a financial instrument.
You're absolutely right, and IFRS has an out for that. It's called the own use exemption.
Own use.
If you entered into the contract and you still hold it for the purpose of actually receiving or delivering the non-financial item, the steel, in your example, according to your normal business needs.
Like my expected purchase or usage requirements.
Precisely. Then it generally falls outside the definition. It's about your intent and whether physical delivery for your own use is the main point.
That makes sense. Accounting follows the economic substance, ideally. Okay, so that's IFRS. Detailed, focused on contractual rights, potential unfavorable exchanges, even net settlement of non-financials. Let's switch tracks. How does US GAAP define things? Where's its emphasis?
Right, US GAAP. Its definition tends to center on three core things. 1, cash.
Simple enough.
2, evidence of an ownership interest in an entity, like shares again. And 3, a contract that obligates one entity to transfer economic benefits to another.
Transfer of economic benefits.
Yeah.
That sounds quite broad, actually.
It is quite broad
Yeah.
phrasing, yeah. You could say it's maybe a bit more principles-based in its high-level wording compared to some of the detailed IFRS criteria.
Does US GAAP then provide more specifics in certain areas to narrow that down?
It does, yeah. A good example is loan commitments.
Okay, what about them?
Generally, under US GAAP, just committing to give someone a loan isn't automatically a financial instrument within the main scope.
Oh, really?
Yeah, it's typically considered outside. However, there are exceptions.
Such as?
Well, if the company has a track record, a past practice, of selling those loan commitments soon after making them like they're acting as a sort of broker.
Right.
Or if the loan commitment itself can be settled net financially.
Ah, similar to the IFRS net settlement idea.
A similar concept, yeah. In those specific cases, US GAAP might treat the commitment as a derivative.
Okay, so that's a clear difference from IFRS, right? How does IFRS usually see loan commitments?
Yeah, it's different. Under IFRS, a loan commitment is often seen as a financial guarantee contract.
Financial guarantee.
Yes, if it requires the lender, the issuer, to make payments to reimburse the potential borrower if that borrower suffers a loss because the original specified debtor defaults.
Okay, so it's focusing on the credit risk aspect.
Exactly. IFRS tends to pull that potential future credit loss obligation into the definition more readily. US GAAP often needs more like that history of selling or the net settlement feature.
That really highlights a different philosophy, doesn't it? IFRS may be quicker to recognize potential future liabilities?
That's a good way to put it. US GAAP often looks for a more sort of concrete present obligation or that market activity signal.
Interesting. Same activity, promising a loan, but viewed differently. Now, the sources also mentioned US GAAP has a specific definition for a security. How does that fit in?
Ah, yes, the security. Under US GAAP, this is a specific category. It requires evidence of debt, like a bond, or ownership, like a stock,
Okay.
or right to get or sell such an instrument. And crucially, it's typically something traded on securities exchanges or markets.
So tradability is key for the US GAAP security definition.
Very key. Think publicly traded stocks and bonds. That's the core idea.
And IFRS, does it have a similar security concept?
Not really, no. IFRS doesn't have one single overarching definition of security that applies across all its financial instrument guidance in the same way.
So how does IFRS handle things like stocks and bonds?
It just applies its general financial instrument principles based on the contractual rights and obligations without needing that specific security label tied explicitly to market trading for all definitional purposes.
So IFRS looks more at the contract's nature, while US GAAP adds that layer of market tradability to define a security within the financial instrument world.
That's a good summary, yeah. That focus on market tradability for the security classification is definitely a US GAAP feature.
Okay. Now, amidst all these differences, are there things both IFRS and US GAAP agree aren't financial instruments? Any common ground on exclusions?
Yes, definitely. There are common exclusions where they generally align.
Like what?
Well, things like Employers' rights and obligations under employee benefit plans, think pensions, those usually have their own separate accounting standards.
Makes sense.
And also certain insurance contracts. If the main point is insurance protection, not financial investment, they're typically scoped out too.
Right. You wouldn't account for your car insurance like a corporate bond.
Exactly. Different economics, different rules.
Okay. The sources also mentioned embedded derivatives. Sounds complicated. Like those Russian nesting dolls.
Ha! That's actually a great analogy, yeah. An embedded derivative is basically a component within a larger contract, the host contract. And this component, if it stood on its own, would actually meet the definition of a derivative.
Can you give an example?
Sure, maybe a company issues a bond, which is the host debt contract. But embedded within that bond is an option allowing the bondholder to convert the bond into a fixed number of the company's shares.
So the conversion option is the embedded derivative.
Precisely. That right to convert is the derivative part, nestled inside the debt contract.
And do IFRS and US GAAP treat these embedded bits the same way?
Both standards say you have to look for them, yes, because they can change the risk profile of the whole contract.
Right.
But there can be differences in the specific rules for when you have to separate that embedded derivative from the host contract and account for it by itself.
So whether you separate it and maybe how you value it if you do separate it could differ.
Exactly. The criteria for separation and sometimes the measurement methods can diverge. It's another area for potential differences.
Okay. Let's just quickly revisit loan commitments because that difference seemed pretty stark.
Sure.
Just to lock it down. IFRS often sees them as financial guarantees because of the potential credit loss obligation.
Focusing on that potential payout if the borrower defaults.
Whereas US GAAP generally keeps them out of scope unless there's that history of selling them quickly or that net settlement possibility.
That's the core distinction, yes. U.S. GAAP's higher bar, looking for market behavior or explicit net settlement features.
Got it. And one last check on those contracts for buying or selling non-financial items. We talked on use. Any other key differences there?
The main point of divergence remains that net settlement capability.
Right.
IFRS generally has a, let's say, wider net. It's more likely to classify these contracts as financial instruments if net settlement is possible, unless that own use exemption clearly applies.
And US GAAP?
US GAAP tends to be narrower. It often requires a clearer sign of intent, an ability to settle net, or perhaps a lack of intent or ability to actually take physical delivery before it pulls such a contract into the financial instrument scope.
So even the own use exemption, while existing in both, might be applied slightly differently in practice.
It can be, yes. The interpretation around the edges can lead to different outcomes.
Okay, wow. We've definitely covered a lot of ground here.
Yeah.
From the basic definition right through to these quite nuanced differences between IFRS and US GAAP. Areas like loan commitments, non-financial contracts, embedded derivatives.
Yeah, it gets complex quickly.
So if we had to boil it down, what are the absolute key takeaways for our listeners? The main distinctions to remember?
I'd say it boils down to a few things. One is the level of explicit detail versus broader principles in some areas.
Okay.
IFRS maybe has more specific rules targeting potential future exposures, like that net settlement for non-financials, or the financial guarantee view of loan commitments. US GAAP, while also principles-based overall, gives more specific exclusions sometimes, like for most loan commitments.
Yeah.
And it puts that distinct emphasis on securities being traded in markets.
Right.
So while both are aiming for good financial reporting,
A true and fair view.
exactly.
Yeah.
They sometimes use different definitions and classifications to get there, and those differences can actually change the numbers on the financial statements.
Which is crucial. So understanding these definitions isn't just academic, it's fundamental for anyone analyzing financial reports, especially if you're comparing companies using different standards.
Absolutely critical.
Yeah.
And as business gets more and more global,
Yeah.
this understanding becomes even more important. Which leads to a final thought, maybe, for you to ponder.
Okay.
Given these subtle, but sometimes really significant differences in how the world's two main accounting frameworks define something as basic as a financial instrument, what are the long-term implications? Especially for investors, analysts, anyone trying to compare companies across borders. How might these definitional differences affect, financial analysis, investment decisions, capital allocation globally?
That's a really big question. How those seemingly small rule differences ripple outwards.
It is. Definitely something critical to keep in mind as you look at global finance.
Please don't forget to subscribe, like, and share this podcast with your friends and colleagues. We've put in a lot of effort to bring this to you, and your support means the world to us.